There are two data sets that help provide investors with a roadmap to market direction. Volatility generally exposes cracks in the system, and the risk-free rate, that's the alternative. 10-year rates started rising at the start of the year, but it wasn't until April this month when it became clear that inflation was more stubborn than we previously thought. It didn't take long for the VIX to jump to levels not seen since October last year. That combination was a toxic cocktail that triggered a decline in risk assets as the narrative of an approaching cutting cycle was no longer certain. Some economists, like former Secretary of Treasury Larry Summers, he suggested that the Fed might actually be forced to raise rates. Last week's reversal, in many ways, adds to the intrigue. Was it the end of a correction or just a reversion to the mean? The VIX collapsed, but rates, they closed a bit higher. Does it throw away the theory that higher rates mean lower prices for stocks? I don't think so. Welcome to The Money Runner. I'm David Nelson. Everyone looks to institutional investors. What are they doing? Ultimately, they'll make decisions on capital allocation based on the available choices. Equity markets can handle higher for longer. In fact, we likely have no choice. But rising rates, that's a whole nother story. When they're rising, you have no idea where it's going to stop, and that uncertainty alone is enough to hold investors back. Last week, I think the large beats from mega-cap giants like Microsoft and Alphabet overshadowed the days earlier concerns of stagflation. We saw a softer-than-expected GDP with a higher-than-expected inflation component. Some investors point to the high inflation, low growth 70s for comparison. Look, this is an important earnings cycle that in part will justify or reject the large returns we saw in the first quarter. Artificial intelligence and AI-related themes certainly a focal point for a lot of those calls. But for the most part, tech has delivered on those promises. But what we're learning is that the development and rollout of AI, it is not cheap. The increased CapEx and spend at Meta helps explain the negative market reaction to what was a better than expected quarter. Increased productivity should help justify higher than normal equity valuations. In the meantime, elevated rates and delayed cuts will likely keep a lid on PE expansion. Some economists, like Goldman's David Kostin, believe that it helps explain the recent trend toward high-quality stocks. I believe elevated rates might delay any sustained rotation into small-cap companies that typically finance their operations with adjustable rate debt. Outside the U.S., higher rates take a toll there too. But in Europe and other markets around the world, we get the added benefit of cheap valuations. In fact, Europe may be closer to the end of an elevated rate cycle, with many economists projecting the ECB will cut rates before its U.S. counterpart. We need some answers. What we need is a solution. What do you do with the above information? A barbell might help. What do I mean by that? Depending on the client's risk bucket, place enough capital on the short end of the treasury curve, 2 years or less. Allocate the remaining capital to your desired combination of risk assets. I don't really care. Large cap, small cap tech, throw in some Bitcoin. With half your capital earning a guaranteed 5%, investors will be able to handle any rising volatility on the risk side of the portfolio. If the correction's over and the market starts to head higher, trust me, you, and if you're an advisor, your client will both make money. The risk-off assets are making 5%, and the risk-on assets, who knows? But all in, you should be making money and sleeping at night. That's it. I'm out of charts. I'm out of talk. If you like the pod, you know the drill. Hit subscribe. And please visit me at my Substack site, dcnelson123 at substack.com. Thanks for joining. I'm David Nelson, and this is The Money Runner.